What's going on YouTube? In this video, we're going over First Solar, ticker symbol FSLR. Year to date, this company's down 1.4% over the course of 1 year, up 9.7%. First Solar, if you don't know, they are known to be the largest solar distributor and manufacturer. They provide solar solutions to several different countries, including Japan, France, Canada, India, Australia, and internationally. So we'll look through their financials here and figure out how First Solar is doing financially. Revenue, gross profit, net income. We have all three are declining, but that goes with the whole solar industry anyway. However, you do look at their revenues here, they seem to be over the course of many years now are starting to kind of trend lower. Same thing with their gross profit. It really hit a peak back here in like 2015 and since has not been able to recover. The only one that's been doing a pretty decent job of staying flat is actually their net income. So we're over here on our net income. We're starting to point negative. Again, that it makes sense right now because of the solar, because of interest rates and how interest rates affect solar so much. So it makes sense in the macro scheme of things here. Gross margin, it looks like I would say their average over there is about 20%, right? In that range. And currently we're sitting at the lowest point we've ever been on gross margin here. Net margin, kind of all over the map here. There's not really a good number for them to go off of because they're up and then they're down and then they're up and then they're down. So, and when they're up big. When they're down, I guess, small, right? So a little bit difficult to understand there. Revenue and gross profit year over year change. We'll have to come over to this chart here so we can see revenue growth year over year. 36, minus 11, 8%, minus 10, 14% growth. So really kind of all over the board there in revenue growth as well. They're up and down, which we've already seen over here. Return on invested capital on this company, same, kind of same thing. A little more consistent, I would say. We're sitting at low, very, very low, basically flat return on invested capital for a rough average on this currently. Cash to short-term debt, they've got plenty of cash to cover their short-term liabilities, which is always good to see. However, they're starting to turn out more liabilities than cash. They've always had more cash than liabilities for the majority of the life of this company up until 2014 there. And as of lately, they've almost, they're up $1 billion compared to where they were the year before. They lost some cash, but now increased their liabilities. However, we do know that they are building a fifth factory, so that could be part of the liabilities, and they're expanding one of their factories, I believe, in Ohio. So that's probably attributing quite a bit to their current to their long-term liabilities there. If that is the case and that is true, then that's to me is not a big deal. Net income to free cash flow. We got more net income than free cash flow. That's always, in this case, it's not very good because we can see our free cash flow is negative. But I always prefer to see more net income than free cash flow because then it tells me that the business is making the majority of its free cash flow. So free cash flow, we can see what it's doing over here. They just cannot get a positive free cash flow in this company. And as of lately, they're starting to turn even more negative on the free cash flow side of things. Their share count dilution here, pretty flat, honestly. Pretty good for this company to not just dilute the shareholders. They've been, I think, very responsible in terms of the shares and finding other ways to make money. Capital expenditure here, growing quite a bit, really quite a bit, a lot of bit. I know that could be partly due to plant property and equipment where they're investing some of that money into their Ohio plant. That could be part of their capital expenditure increase there. So this might peak and then shrink again and maybe get back into the 750-ish range for millions. So overall, it's a bit choppy on the financials here. There's not a very clear direction. It doesn't look like it's going straight down, but it doesn't look like it's going straight up. It just kind of looks like it's bouncing around. There's not a lot personally that I like. I wouldn't invest yet into this because they haven't proven to me that, yes, this is going to be a consistently profitable company. As you can see, their net margin is just hovering around zero. If they were consistently sitting at like 10% and then maybe this year they would drop down to like 5%, then I get it. I get that. But, They're just kind of all over the board, and they've only ever peaked really in 2015 is their best year ever by the looks of overall financials here on this company. But they are working on growing. They got one factory growing, and then they've also got expansion on one other factory, so that's good to see. We also know on First Solar as well that capacity is growing and backlog pushes them out to like 2030. So we can see here in this article that was written, fifth building of manufacturing building will cost them $1.1 billion. They're going to put that in Louisiana, and this new facility is basically funded by the Inflation Reduction Act, the IRA Act, that was passed in August 2022. It is expected to come online in 2026. This factory, I believe, that brings 3.5 more gigawatts of manufacturing capacity per year and adding to its existing 11.5. So they've got more than 8. I thought they was okay. So they're going to have about 15 gigawatts per year. So just this year alone, they're also going to spend $1.7 billion on expanding at a new site in Alabama and expanding a facility in Ohio. So maybe they're planning for two more factories. So they've just talked about it. Their company has made plans to spend the additional, so they haven't done it yet. Okay, I see. So there's a chance they're going to make a second factory and then also expand the facility in Ohio as well. With their current production rates that they have is sitting at 11.5 gigawatts per year. They have a backlog of 77.8 gigawatts. So that's, you can tell, as you can see that puts them out to like, so if you take, 11 divided by, 78 there, that's what, 7-ish years of backlog orders that this company currently has. So that puts them all the way up to like 2030. So that's, that kind of gives you some certainty that the company will consistently be making money. Obviously they're going to have to spend money to grow the business and make more factories and stuff like that. So something to be aware of, I guess, on that side of things. But, they're working on growing the business. But the only downside, I wouldn't say it's a downside, but it is the only reason they're able to grow the business is based on the subsidies they're getting from the government. So, and I shouldn't say that's the only reason, but that appears to be one of the main reasons why they're doing it. So over here on their most recent earnings release, we can kind of see there's a few key things in here that I thought was worth sharing. So we saw on our net sales, this is over the 6 months, we had cost of sales on this company of basically 1 billion last year and a little bit down this year. However, they did 987 billion, but 1.4 billion. So their cost of sales, they've corrected and reduced quite a bit. And I think that right there is one of the biggest reasons why this particular solar stock has not yet been destroyed because of the current interest rates. So I think that is a huge hurdle that this company has overcome as long as they can sustain that. If they can sustain that, I think they've got a good future ahead of them, and I think the financials on this company are going to start turning around and looking pretty good. Control of operating expenses, not quite double, but almost doubled. Hopefully they can keep on controlling that a little bit better yet, but obviously they're going to be building a new factory and expanding another one and potentially building another factory. So two factories and expanding one, it's going to require more SG&A for sure. So that's probably going to end up continuing higher for a little while anyway. So interest income, they do have a lot of their cash sitting in interest accounts, so they're generating a little bit of extra income. So that's always good. So over here we can see they've got about $1 billion in marketable securities that is earning them interest. Inventories, compared to other companies, I believe this seems to be relatively well controlled. So that's always another good thing. However, they do have so many orders. I'm surprised. Maybe those orders are, say, I want these delivered January 15th, 2024. So maybe that's how those orders are working. Maybe it's not just like once they have finished those orders that they ship them out right away. It's probably has specific ship dates. They also added long-term debt, potentially from new plant, maybe the expansion. Down here at the cash flows, we have our 6 months again. We have our net income, 213 compared to 12 million last year. So Very nice year-over-year growth on the net income side of things there. And basically, the only reason this company is negative free cash flows is from their changes in operating assets and liabilities. So then, because of all the changes within the balance sheet, that brings them at a negative $124 million free cash flow. So I meant operating activities. They have $124 million, negative $124 million cash from operating activities. So we have down here our capital expenditures. So we went from 353 to 753. I'm wondering if this increase from CapEx here wasn't actually genuinely from some of the purchase of property, plant, and equipment that this company has. So it's not fully capital expenditures because it's not listed as that, but typically that column is a CapEx or something similar to it. So if you don't have an individual capital expenditure in your cash flows from investing activities, then usually you use purchase of property and equipment or PPP&E, and then that's while you figure out what your free cash flow is. But because this company we've known is expanding, I believe that a good chunk of this is from buying or investing into their future plant. So I'm not sure this is a valid capital expenditure. Currently, I do think this is going to shrink as we've seen over here on our capital expenditures. Like I was saying before, it exploded, ignited lower really, but I think if once these factories are finished, this might retract back up to maybe like a $750 million capital expenditure range roughly. That's my guess. I would assume that would be how that's going to work out on this company or on their capital expenditures. So, and then that'll, if they can if they can maintain that net income that we saw up here, I think they're gonna have no problem turning a net margin profit or a positive net margin in the future. So honestly, so far it actually kind of continues to get better and better and better at this company. So I kind of like what I'm seeing so far. So we got some comps to compare to. We have Enphase, Solar Edge, and Run Energy. We've already gone through basically all these red flags in this company. However, we have profit margin that's kind of low. We have return on equity and return on invested capital, which are very low. It should be higher than that. Well, not should be, but I require higher than that. It should be like 15% or more for me. Share change year over year. Currently growing very slowly, so not a big deal there, which we've seen the share count is actually pretty good. And we have operating cash flow, which is higher than our net income, but this is over the trailing 12 months. So as of lately, this is actually not true. All right, down here at our market cap, we have our four companies, market cap and revenue on the right-hand side. First Solar and Phase are leaders currently in the market cap. So we have revenue, gross profit, net income. Solar Edge has the highest revenue count. Probably the Enphase has the highest gross profit. Enphase has the highest net income of the group. 5-year growth rate across the company here. Looks like Solar Edge has a high EPS growth rate, but the rest of them, we're all looking at, man, like 30+% on the EPS and then 25-ish, mid to low 20s on the revenue growth rate as well. Pretty good. Gross margin here. So we can see Enphase has a fantastic gross margin. For Solar, they're working on it. We've gone through, but we're comparing this to other companies, so they're not going to look nearly as good because they aren't quite there yet. Operating margin, Enphase takes the cake on that. Profit margin, same thing over here. We can kind of see just First Solar just isn't the worst company on the board here, but it doesn't look that great either. So free cash flow, negative. The only company that is positive free cash flow is actually Enphase, which is a big deal in my opinion. Return on invested capital, Enphase 24% return on invested capital, and a PE on First Solar right now, you're sitting at 100. So that kind of tells you immediately that this company is very overvalued, very richly valued today based on its current earnings. Enphase is sitting at 30, 24, 22 on Solar Edge, and 23 on Run Energy. Calculator on First Solar, we have Peter Lynch valuation gives them 93.72%, or sorry, dollars. Multiples comparison, we have our three companies that we just compared to, gives us a price tag of $39.90 per share. Manual PE in this company is sitting fairly valued. If we take our market cap, minus our cash, add back in debt, divided by our cash from operations, we get 20.5 PE on this company, which is fairly valued. Price to book, we're sitting at higher than 5-year average on the price to book. PEG ratio, currently very richly valued on the PEG, but forward looking, very undervalued. Graham's valuation gives them a $91.03 per share. Discounted cash flow. We're gonna, because this company is negative free cash flow, we won't include this in our final fair market value number. So the analysts have a growth rate in this company of 0%. They didn't even list the growth rate. I figured 20%, but because this company is currently negative free cash flow, and it might start turning a positive free cash flow, but currently in our most recent 6 months earnings release, that is not true. Rule 72, we have our EPS, PE, three different EPS growth rate sources here. Gives us an average 23.2%. 23.2 goes into 72 three times, three times, or 3 goes into 10, 3.2 times. So what we get to do is double our EPS 3.2 times. So we get to give it basically a 12 for future EPS. For fair market value on this for Rule 72 is $139.20. So here we go. First Solar currently trading at $143.40 or 80 cents per share. And we're gonna remove our discounted cash flow. So we'll delete that. So that gives us a fair market value of $90.96 per share. 30% margin safety, $63.67. Analyst price target on this company is $234.36. So we're pretty far away from where the analysts are, but the analysts are really far away from the price target as well. So I'm wondering if this company, I haven't even looked at the stock chart yet either. So I'm wondering if this company hasn't quite hit the old solar bear market, I guess you'd say. All right, so on the stock chart on First Solar, we can see it was probably a matter of time on this company before the whole solar bear market hit this company as well, and we can see it appears as though that is possibly happening. So this is quite the bleed out here, and this is something not to get in front of. This is probably going much, much lower. There's no current, I mean, there's a little bit of support here, but not, I don't think that's enough to hold this thing up based on how hard it's selling off. In my opinion, I think this thing's coming down to at least 118, and then it's probably, it can do whatever it wants. It could hang out around here, maybe show a little bit of a bounce, a relief, and then potential roll over and probably get close to what might be, if it follows this uptrend here and pulls back into this, by the time it maybe gets to it, it could be about $94 to $98 per share, which is right where our fair market value is on this company. And also by then, our fair market value for this company might be higher than what it is right now, but depending on how the financials look over the company, right? So I think the only reason analysts have a price target of $234 per share is because a lot of them are trying to get everyday investors to buy this company back up to that price tag so that way they can get out. And so they're manipulating their price target to that way you can think, oh, it's worth $234, when in reality it's not worth anything near that. And it's currently rolling over. It honestly, it's headed for much lower price target here. Maybe you could pick up some here, but I wouldn't trust it there. I would start to trust it in this $90 range, honestly, not just because our price target was there, but because that's what it looks like it's going to reach technically. We have quite the support range in this probably $75 to $80 range. That's where this line is here. So that would probably be a very solid bottom, a great buying opportunity on this company is if it reaches that $75 to $80 range, um, assuming financials still hold up and everything, right? Just want to look at that and the fundamentals, say fundamental things too. But, that's how it looks like on the stock chart to me. This is something to step aside and watch it continue to fall, in my opinion. This thing does not look like it has any support to bounce at any time soon. It's got at least another $20, $30 left in it before it sees some sort of a bounce potentially, or at least a rest. But looking pretty bloody over here on First Solar. If you can compare end phase, look at end phase. Look at what end phase did. I went from $340 all the way down to $120 per share. I mean, you can't really expect First Solar to not to do something similar. First Solar is definitely lagged behind. So I would definitely anticipate this thing coming down to $75 per share. Once you think it hits a ceiling or a bottom, then it's probably got a little bit more room left in it lower. So based on how Enphase traded, that I'm guessing that's what this is going to do eventually. And it might not, but I would probably anticipate for it. So that's it on First Solar. If you found value in this video, drop a like, subscribe, comment, and we'll be back later with another stock analysis video.